Good afternoon, everyone. It's a pleasure to be back in another round of the Faculty Insight series. We have sort of another excellent topic today to discuss with an even more excellent speaker who's going to discuss it. As you know, beginning mid-February and especially in March of this year, once the pandemic took hold in the United States and several of the economies, especially in Europe, it has been nothing short of, I would say, a fairly spectacular collapse of prices in equity markets, in secondary loan markets, in terms of spikes in yields, in investment grade junk bonds. And as we saw earlier in the series, the volatility that was associated with all this did not spare even the safe haven instruments such as the US Treasuries, which have also had fairly extraordinary collapse. Now, of course, it would be a mistake not to add to all this the volatility in the oil markets. The oil price, as you know, yesterday the WTI closed at a record price below zero, something that was not thought as a reasonable price to expect in a market for physical asset. But, you know, the oil volatility has also been through the roof. It has been close to 100% since the unfolding of the pandemic in the Western economies. And all this raises fairly difficult questions about the quality of credit that we are likely to have in the markets, both in terms of what it means for the risk of credit deterioration of existing names, the ability of these names to access the bond markets in future. Those who are borrowing in the loan market, they might possibly default on their bank loans as well. Nevertheless, it does also raise the question of whether we had a somewhat vulnerable starting point in the first place. And that's the perspective Ed is going to offer to us, which is, why did we have such a meltdown in the credit markets in just a fortnight and what seems to be continuing beyond? Over to you, Ed. Please go on for 25, 30 minutes as you wish. And I'll take questions at the end. You don't have to worry about the Q&A box. I'll curate them for you. Over to you.
Thanks very much, Viral. Good afternoon, everyone. Good afternoon to our NYU students, our faculty, our colleagues at NYU, our alumni, and even some special guests from in New York, but also from other parts of the world, including Italy and Poland, and perhaps others. So it's a real pleasure to be part of this very important series. I'd like to thank very much the IT staff at NYU and also Viral Acharya, who you just heard, as the main organizer and catalyst for this faculty series. And I hope that what we're going to talk about today resonates and supplements what you've been hearing in the media and also in academia, as well as the policymakers around the world. As some of you know, I've been at NYU now for 53 years. I haven't figured out a way to get another job, and so I'm hanging around here. And I must say it's been a wonderful journey. And I'd like to share with you today a very important topic, and that deals with the credit cycle, and particularly the credit cycle before and after the realization of the crisis, and particularly the crisis realization in the United States, and its impact on the credit markets, both within the fortnight that Viral mentioned and subsequent to that. And I will be drawing upon a number of models and techniques that I've developed over the years, to try to analyze the situation, not only what's happened, but our forecast for the next 12 months, if not further. And I'd like you to certainly answer questions afterwards, as Viral mentioned. Whenever I discuss the credit cycle, I look at four main indicators to tell me where we are, whether or not it's a benign cycle, a stress cycle, perhaps even a financial crisis. And those four indicators are the following, and I'll be drawing upon these four as we discuss further. The first is the obvious one, default rates in the economy, both in terms of companies and in this case also talking about consumers and individuals and indeed sovereigns at some point. The default rate is particularly relevant for the so-called high-yield bond, junk bond market. And I'll be drawing upon those numbers because that really is the epicenter with respect to potential defaults. And when they occur, it's a very easy and convenient and important way to monitor defaults in our economy, and particularly about issuers of bonds and also loans. The second variable is the recovery rate. That is, given a default, what are the prices of these defaulted securities right afterwards and potentially at the end of the restructuring period, and also its impact on investors, both the ones who own the securities and potentially the distressed investors who are interested in purchasing them. The third variable are the yields and spreads required by investors in risky debt markets. And related to the risky debt markets, there's another ratio that I'll be drawing upon that is very important in this particular context. It's called the distressed ratio. This is the percent of high-yield bonds that are trading more than 10% or 1,000 basis points above the risk-free rate. In today's market, that would be about 10.6% yield to maturity, or an option-adjusted spread, which is the market convention that is being used now for this distress ratio. And finally, the liquidity in the markets. Very important, probably the most difficult to analyze in terms of predictions, and it's the one that moves most quickly. Although in this current crisis, all of these variables, both in terms of current and potential forecasts, are moving so quickly that they're changing from day to day. And that's very difficult to monitor with respect to forecasts. So those four variables, default rates, recovery rates, yield spreads, and distress ratio, and finally, liquidity. Now, it's very important, as Viral mentioned, I think, when we're discussing the credit cycle, to see where we were before the crisis, because that's going to impact what happens when there is a catalyst for a change in the credit cycle. In this case, the coronavirus situation, which I believe in the United States, the realization that this was a real crisis occurred in early and mid-March, even though there were certainly indications earlier coming from China, Italy, and a number of other countries. And unfortunately, we didn't react too quickly here, both in terms of safety issues, but also in terms of the capital markets until about, I would say, the first week in March. So let's take us through those four variables and what was going on at the end of 2019, and we'll look at what happened afterwards. At the end of 2019, the default rate on high-yield bonds was 2.9%. That's slightly below the historic average of 3.3%. These are measured in dollar terms, and we are certainly the ones who are dealing with this. And also, the default rate of 2.9% was rising from prior years, but it hadn't yet reached the historic average, so still benign. Recovery rates actually were the first indicator that showed a potential problem, and they were dropping below the historic average to around 43 cents on the dollar with respect to corporate bonds after they default. The historic average is 46%, so just about the historic average there. The third variable, yields and spreads. The yield spread is the required rate of return above the risk-free rate, and that was, at the end of 2019, just a little over 400 basis points, or 4%, as a premium. This was over 100 basis points, or 1%, below the historic average. So investors weren't very concerned with risk. In fact, there was risk on for quite a long time, including the end of 2019, and liquidity was going through the roof. Indeed, in the first 2 months or month and a half of 2020, there was more new issues of risky debt than ever before. It broke all records in the first month and a half. And so the markets were completely caught by surprise by the crisis and what happened afterwards. All four indicators, or three of the four certainly, were pointing to a benign credit cycle. And I'll come back to that and show you that graphically in a moment. Then, of course, things changed in early March. I gave a speech on March 6th, so I remember that date very well. And the yield spread went from 414 to 560, about 150 basis point increase in such a short period of time, which already was indicating stress in the economy, in the health situation, and in the risky debt markets. Also, liquidity was beginning to dry up, but not completely yet. And the distress ratio, which was 8.2%, I'm sorry for all these numbers, but 8.2% is very low at the end of 2019, spiked already in early March to around 15%, almost double. And this was an indication that a lot of companies which were not considered distressed and default candidates all of a sudden were. And by the way, that 15% spiked to almost 40% of the market 2 weeks later in that fortnight period. And today is about 26% as the markets have come back a bit. So that was the scenario in March, beginning of March of this year. And it was clear that we were still in a benign cycle until the beginning of March. But there were incredible, in my opinion, storm clouds on the horizon, even at the end of 2019. So I'd like to take you through that very carefully so you have that background. Could we see the first slide, please? So what this shows is an indication of how much debt there is in the economy, and particularly I'm focusing on the corporate debt. And first, I'd like to generalize and say there was an enormous buildup in debt, but some skeptics about this buildup of debt, and particularly some of my colleagues, might be saying, well, don't worry about the amount of debt that companies are issuing, which were at record levels to take advantage of the low interest rates. Don't worry about it because the equity of these companies has also been increasing dramatically. And so you had a debt equity ratio that was relatively benign, not showing much difference in the last 10 years, and certainly nothing like it was in 2008. You can see in the middle of that chart, the debt equity ratio was by far the highest, approaching 70% for all corporates. My answer to that skepticism is yes, equity markets were frothy, no question about it. But if you stress those equity markets by, say, a downturn in the S&P 500 or the New York Stock Exchange index of 20, 30, or 40%, then the debt equity ratios don't look benign anymore at all. And you can see that on the right-hand side of the slide. The debt equity ratio, if you stress by 20, 30, or 40% decline in the market, become very, very formidable and almost like it was in 2008 when, of course, the stock market fell dramatically and debt levels were very high. Next slide, please. This is a very important slide, and it's very important for a couple of reasons that we're going to discuss in a moment. The blue line represents the non-financial corporate debt as a percentage of GDP. And the red dotted line represents default rates in the high yield bond market. Notice the remarkable 3 prior peaks in that non-financial corporate debt as a percentage of GDP. It's like a debt to cash flow ratio to some extent. Was around 43% one peak, then 45%, and a little over 45%. In every case, within 12 months, what followed was a dramatic spike and peak again, in this case, in default rates. In 1991, in 0102, and again in 0809. And particularly 09 was a very high default rates, the highest being in 2002, by the way, of over 14% in this case. Now, let's look at the current situation. At the end of 2019, that debt to GDP ratio not only spiked to a new peak, but it was the highest peak we've ever had at over 47% of GDP just in corporate debt. And so the question is, what's going to be the reaction to default rates, to bankruptcies, to distortions in the supply chain, et cetera? And if you notice on the lower right-hand side, we're still at a relatively low last 12-month default rate. And the question is, what will happen going forward when there is a change in the credit cycle? Next slide, please. And this slide shows you much the same thing, except it brings in one important new variable: economic recessions. The yellow bars represent economic recessions in the United States. We're very blessed in the United States, if you study defaults and bankruptcies and the economic cycle, to have many recessions in the past. It's the nature of our economy. And the last 3 of them, you notice the relationship between recession and default rates. The default rates are in the solid line there. And in every case, the default rates again peak at the end of a recession or shortly thereafter. So the bottom line that I'd like to mention here is that if we have a recession, and now everyone is forecasting a recession globally as well as in the US, we're going to have a spike in defaults. But keep in mind, this time it's at record levels of debt prior to those spiking in defaults. And I'm going to come back to the real economy and its relationship to default rates, its relationship to the pandemic, the corona crisis that we are now also very familiar with and living through. So now let's talk about what happened at the end of March. At the end of March of this year, and in fact the last 2 weeks of March in particular, all the variables that I've mentioned earlier changed dramatically. For example, default rates began to rise, although it takes a while for companies to default, particularly big ones, as well as even middle-sized ones and small ones. And so we have not seen the big spike in defaults and bankruptcies yet. Year to date, my numbers of default rates are about 1.5%, but those are not including a vast number of companies now that are distressed, particularly in the oil industry and gas industry that Viral mentioned. With the price of oil so low, we can expect in normal times a lot of defaults. Imagine in this current period when the price of oil was in single digits prior to yesterday. That's impossible to continue to operate, particularly in the United States when you have so much leverage in the system for these companies. Incidentally, oil and gas companies comprise close to 20% of the high yield market. And if there's a big default rate in the oil and gas industry, it means automatically it's going to be a big one there in the oil and gas industry as well. Also, at the end of March of this year, yield spread spiked to 1,000 basis points or more. That was about double what it was at the beginning of March. But keep in mind, I don't have a slide to show it, but keep in mind that in 2008, the yield spread reached over 20%. And so we were at 10% then. Today it's about 8%. We were at 10% then at the end of March. But if things really spiraled downward, there was actually another 1,000 basis point spread, which is enormous, that could happen, and then we would match December 2008. So keep that in mind as well. Recovery rates have begun to drop. Yield spreads, as I said, were at about 1,000 basis points. And the distress ratio, very importantly, spiked to almost 40% of high yield bonds distressed. It fell back to around 34% when I did my forecast. And today it's about 26%. Still far above the historic median of around 11%. So we're way above the things in this distress ratio. And by the way, this is looked at. It's a ratio I came about in 1990 when I was writing about distressed debt for the first time, and it is followed very closely by analysts in the marketplace today. So in summary, storm clouds were there before. We have this crisis now, and it's impacting many things in the financial markets, and I'll get to in a moment the real economy. Let's talk now about our forecast for default rates going forward, given what was there before, what's happened in the last month or so, and also drawing upon a number of models that I and others are using to forecast default rates. By the way, Viral and others, default rate prediction is very hazardous, very challenging. Someone once said, never forecast. But if you do, never put it in writing. But if you do it frequently. And I think a lot of my colleagues who do default rate forecasting, like rating agencies and some of the investment banks, and maybe even some academics in this area, but there are very few who has this challenging forecast. They do it quite frequently, because especially now when things are changing so fast. Let's talk about forecasting and drawing upon models. I use 3 models for forecasting default rates. One is something called the mortality rate approach. Just like an insurance actuary looks at people when they are born, we look at bonds and loans when they are born, and particularly at their bond rating at issuance. And then we track the frequency of defaults 1 year, 2 year, up to 10 years after that occurrence. Next slide, please. The default rate, and by the way, you'll be able to get access to these slides, and you have a copy of my paper, and most of what I'm talking about today, except for the fact that it was written at the end of March, is available in the paper that hopefully you got sent to you, and you can download at your pleasure or not afterwards. Now, this table shows the last 40 plus years of history of a model I developed in 1989 and maintain and update each year of the frequency of defaults given an original rating. But keep in mind, this is a lot more robust than the typical cumulative default rate tables that are available from rating agencies, in the fact that it takes into consideration original rating, migration, and particularly the aging of the bonds as they get older. But also keep in mind, this is 40 plus years of history. It is not during a financial crisis, and certainly not during in a pandemic. and this unprecedented situation is not captured specifically in any of this data. And that makes it difficult in all sorts of forecasting, GDP, default rates, et cetera. But anyway, we look at the last 10 years of issuance by original rating, and then we track that amount 1 to 10 years afterwards and come up with an expected default rate based on a combination of growth periods, distress periods, some crises in there. There's at least 3 periods of crises. And these tables are very important and are used again by lots of practitioners now to look at cumulative expected defaults. The result of that was a forecast for 2020 at the end of 2019, I only do it once a year, of about 6%. And that is, of course, much higher than it's been, but still below the record levels of prior default periods. The next 2 techniques are based on what the market is saying, yield spreads and distress ratios. Using those 2 techniques and weighting, coming up with a forecast of around 10% for yields based on yield spreads and about 8% based on the distress ratio, weighting the 3 together, I came up with about a 7% expected default rate for the next 12 months, and this was done at the end of March. Now, one final thing, and perhaps we'll get back to this later, very important new aspect of the debt markets that perhaps is not well understood by a lot of people, and that is the triple B phenomena. The amount of triple B bonds that have been issued by U.S. companies, triple B being the lowest of the investment grade and just above high yield and junk. It seems to be the rating of choice because their spreads were very low, the yields were low, interest rates were attractive, and lots of companies wanted to use as much of the debt markets to raise their return to equity of their shareholders. And so that market exploded to almost $3.5 trillion, by far the most populated rating class at the end of 2019. And we're going to come back to that perhaps later, but I add a 1%, if you call it arbitrary factor, to the expected default rates because of some factor that I'm going to talk about perhaps later, dealing with crowding out and zombie firms and the fact that this will add to the default rate. Anyway, bottom line, my forecast then was about 8% for the next 12 months. That was relatively low compared to most of the professionals out there, but it's what I'm still sticking as my forecast. If we use current data, by the way, you probably know that the markets, at least until Friday of last week, have come back in terms of stock prices, in terms of yield spreads have dropped to around 800 from 1,000. And the markets seem to be shrugging off, you know, all this bad news about the health crisis. I couldn't really understand why, but there were, of course, movements on the part of the Fed, the Congress, the Fed again, and then we can expect very soon another movement of the Congress. Unprecedented amounts of support and stimuli for the U.S. economy, and it's being mirrored to some extent in other countries. And I'll come back to that in a moment. The last thing I'd like to talk about before we go to the Q&A is the real economy. And of course, that is so critical to what's going to happen to the financial markets and vice versa, by the way. It's not really clear to me as an economist as to which one really moves first, the financial markets or the real economy. But there's no question that when both of them are moving in the wrong direction, when you have a recession and you have maybe a prior increase in default rates and others, you have the scenario of an extremely stressed, perhaps a financial crisis. And so let's talk about the real economy now. Now, one caveat is this is not my specialty, to forecast GDP, but I'm reading a lot And you can say there's a lot of uncertainty out there about its impact. But let me tell you what I think is pretty clear to just about everyone. One is that there's no question that Q1 will be quite bad in 2020, particularly when we hear a number of companies reporting their earnings in the next 10 days. And also that the GDP, when we hear about it, no doubt will decline quite a bit, but probably will not be negative, although I don't really know that for sure. Second is the issue of Q3. Well, here's where some people disagree, but I think most people now are coming around to the fact that the recessionary period will last a lot longer than one quarter and probably will be in a full-fledged recession in Q3 and probably Q4, and therefore making the year 2020 clearly a recession year. And now the question is, how much longer will it last beyond that? And while I don't really know the answer to that, increasingly economists are pointing toward a much longer period before things turn around. And of course, the government is doing what they can with these new stimuli, and also the Treasury is trying to reduce as much as possible the pressures on the economy by helping companies, small companies, particularly with loans, et cetera, larger companies with support for their bonds and loans by purchases by the Fed. And I think most people agree what's been done so far has been helpful, but not enough. And so that's why we're going to observe even more. And so now we're pretty sure that the economy will go into a recession and stay there for at least several quarters, if not into 2020 and even 21. Therefore, we can expect what I showed you before with that spike in debt prior to this period, a big spike in defaults, perhaps to record levels in 2020, 2021, not 2020, when I think it'll be below the peaks of the past, but 2020, there's going to be the knock-on effect occurring quite a bit in that period. Finally, what will it take really to come out of the downturn? And I see it as three things happening and needing to happen almost simultaneously. One, consumers need to start buying again. That was the biggest stimuli for our economy up to the crisis. It's very doubtful that those people, and so many people unemployed now, will who are traumatized in this period, will start spending big time once the health crisis seems to be under control. Yes, they will spend more, but I doubt if they'll spend as much as was the case prior to this crisis. The situation will be probably the financial markets, that is the credit markets and the equity markets, will snap back before the real economy does in any meaningful way. And so I'm very concerned about the real economy going forward. With those final comments, I will now turn it over to Viral for the Q&A.
Thank you, Ed. Very stimulating and full of not just the data and the analysis and the substance, but always a coherent narrative, which is so critical to make sense of the various moving parts of the economy and financial markets right now. Let me kick off the Q&A with a question, which is, you've constructed this Z-score measure, of course, since your PhD dissertation, and it's simple, it's very easy to construct, it has stood the test of time, and it has remarkably almost always helped you get a handle on when the next credit market downturn is likely, including this one, in fact. So my question is, what are the Z-scores showing right now, especially for some of the troubled spots of the credit markets that you mentioned, such as the oil sector and the triple B space.
Well, thank you very much, Viral, for mentioning that. I'm probably as surprised as anyone that the Z-score model is still around after 50 plus years and is still going quite well and is used as much as it is in the markets. It's very difficult to run the Z-score model today on large numbers of companies because their financial performance really has not been provided yet in terms of the impact of the crisis. And it's going to be a rolling series of numbers going forward. But what we can do, and what we did with respect to the Z-score, is look at this very important, very explosive triple B market that I mentioned before. Again, $3.5 trillion of triple B bonds, a large number and rate of growth also in triple B loans. Now they are poised for perhaps being stressed in this downturn. So the big question was, and by the way, this was something that was discussed even before the crisis in the literature, but particularly in the professional literature by the rating agencies and some investment banks. And I began to get interested in it because of that. What will be the amount of these triple B bonds that get downgraded to double B and B in a downturn? And how large will that be, and what impact will it have? So I decided to look at what they were saying, and they were saying most of the time that the most amount of these downgrades will be about 10% over 2 to 3 years of a downturn. 10% of 3.5 trillion is about 350 billion. Well, that's a reasonably high amount of bonds being downgraded. The high yield market, which is about 1.5, 1.6 trillion, will not be impacted that much, was the conclusion of the pundits out there, and particularly the rating agencies. I decided to take a different tact. Rather than look historically at what has happened when there was a downturn, which I don't mean is not important, but I think this one is really different. And the main difference is this enormous buildup in triple Bs. They weren't that prominent back in 2007, prior to the last crisis, and certainly before that. And secondly, we have a new type of crisis, and we have the oil situation as well. So I decided to apply the Z-scores to as many triple Bs as I could find at the end of 2019 when the data was available. Could I have the next slide, please? I do have some more data on that I could show. Okay, so first of all, for those of you who have not seen it before, this is the infamous or famous, or what do you want to call it, Z-score model, 5 variables, as Viral said, very simple data that you can get from financial statements, a weighting factor based on statistical analysis, and we end up with a score. Next slide, please. This, by the way, is the way I'm currently looking at the impact of Z-scores on what's called bond rating equivalence. So, for example, on the left-hand side, the last time we did it was 2017. We can look at the average or median Z-score by rating. So, for example, if a firm has a Z-score of 1.6, we ascribe that as a B-rated equivalent. And then we can look at subsequent data on mortality rates for Bs to determine expected defaults going forward. Next slide. This is a hybrid of the Z-score called Z double prime, and it's particularly good for non-manufacturing companies and also private companies because it doesn't rely on a stock price as the other variable did. For variables, new sets of coefficients. Next slide, please. And this, when you have a chance to look at it, are the bond rating equivalents by pluses and minuses, by the way, in this case. So with that as a background, let's look at the triple B population at the end of 2019. Next slide, please. And the last one. Okay, so what we looked at rather than saying what the rating agencies were likely to do, and by the way, I can't predict what they're going to do because they're the ones that do it, and it might be their choice might be a self-fulfilling prophecy that say it won't be more than 10%. Instead, what I found is applying the Z-score and the Z double prime score to 2019 companies, over 230 in terms of the Z double prime, that around 35% of triple Bs at the end of 2019 did not seem to deserve the triple B rating. In other words, there was somewhat of a rating inflation, if you would call it, or there was this feeling that these companies could, when they wanted to, go back on their target capital to their target capital structures and raise equity to reduce the amount of debt. And therefore, they were given a triple B rating. But we feel that they have so much debt and that their operating profits in some cases are vulnerable, that more than 35% look like they are non-investment grade at the end of 2019. Imagine what's going to happen in 2020 and 2021. Now, the reason why this is so important is the so-called crowding out effect. That is, the lower quality firms, the B minuses and triple Cs, many of them have been kept alive artificially by low interest rates and extremely liquid capital markets, will fall by the wayside much more quickly when they have now new competition for raising funds from the fallen angels that were downgraded from triple B to double B, or at least the market feels that their risks are now more like a double B or B quality. And by the way, in the first week of this crisis, at the end of March, already about $100 billion of triple Bs, about 15 companies were downgraded to double B already. And there are estimates now by professionals out there that this year alone will be $300 to $400 billion of downgrades. And we're talking now potentially of 2 to 3 years. So I think there will be this crowding out effect. I raised the default rate expectation by only 1%. I think I was being very conservative on that. And this crowding out effect should not be forgotten. Thank you for the question.
Thank you, Ed. There's a question by Mikhail Klon, which you have partly covered in the sense of the vulnerability of the United States in terms of sharp increase in credit risk. But interestingly, he also refers to Italy as being another country that might be vulnerable. So let me turn Mikhail's question into something that we have discussed a lot, but I would love to hear your thoughts further, which is, do you see a risk that as this wave of downgrades hits the market, possibly also creating distress for banks on their loan portfolios, that we might possibly see a rerun in the United States of what had happened after what has happened elsewhere in Europe after the global financial crisis and the European sovereign debt crisis, and in Japan in the 1990s, which is that there's a reluctance actually to accept defaults. You try to forbear, you try to extend and pretend that everything is fine. Bank losses are so large that regulators cave in and take a forbearing approach to marking these loans down. And you end up with an economy that is full of heavily distressed zombie firms. And could that potentially be one of the bottlenecks to a speedy recovery as we emerge out of the impact of the health virus? So put another way, Ed, my question is, are you in favor of using the bankruptcy system as we have been using it to achieve reasonably efficient and speedy resolution of these distress? Or would you say that we might be in the realm of a possibility of seeing zombification of the economy in order to prevent banks from taking losses and so on?
Yeah, there's a lot of great aspects to that question, some of which I can speak about, and some perhaps is more speculation. A couple of things. First of all, you mentioned Italy, and I think in general Europe is in far worse shape than the United States in terms of the impact of this crisis. They already started out at a much lower level in GDP growth. Italy was probably going to be in a recession anyway. Imagine what it will be now. I think the forecasts are at least 8, 9, 10% negative GDP for this year. And also the bank situation. Well, one difference between today and what was in 2007 is the fact that the banks today are much better capitalized. They have more equity, particularly, again, in the United States, less so in Europe. And therefore, these increase in defaults are going to be less of a impact on the U.S. banks in general. However, we've already seen all the major banks in the United States have reported their first, or just about all of them, their first quarter results. And they have also reported their reserves that they're setting aside for the expected wave of defaults. And I think the general number is between something like 5 to 10 billion in for each bank of these bigger banks setting aside reserves for defaults. And it was said that this was somewhat conservative on the part of the banks, that in fact that they didn't expect it to be that high. I'm not as sanguine as that for the banks. I think this amount will need to be increased going forward, particularly on the leveraged loan defaults that will take place. It's already beginning to escalate there. Yes, the zombie companies, especially the smaller and medium-sized firms. And by the way, there's a big issue that I haven't mentioned dealing with non-bank lenders as well as bank lenders and how important they are in today's economy. And I'll get back to that perhaps. But one statistic is startling. 42% estimated by Bank of America of all lending in the loan market is from non-banks today. So if we talk about the banks having problems, well, we got to be very concerned with the non-banks too, and what will that do to the availability of credit. But getting to the banks, so they're set aside already big reserves, and they can do that, of course, with higher amounts of capital. And I think they can absorb a lot more. The government is very concerned with the banks as well, but they're not stating it as that. They're trying to support the companies to more loans, which I think is very iffy. It may help consumer spending with the payroll assistance, but I don't see it helping the bigger companies that much. And a lot of companies don't even want these loans. I think they're sending back the money to the to the system. And a lot of that is being processed through the banks, and it's not been processed that efficiently, according to what I read. But but I think the big problem in banking is going to be in Europe. The Italian banks and the Spanish banks, again, are going to be hit very hard further. One thing that they have in the Italy now and other countries is a much greater incentive to sell these bad loans rather than keep them on their balance sheet. So I don't expect that the zombie effect will be as great as it could have been if they didn't have this greater incentive on the part of the banks to sell their bad loans and take the hit, hopefully at a price. There's a concept in Italy called UTP. Rather than non-performing, unlikely to pay, UTP, which is now becoming quite important. And those type of loans, if sold early enough, could help the bankruptcy system to turn them around. Unfortunately, their bankruptcy system is still quite a bit behind ours in terms of the Chapter 11, but they are making strides in that thing. So yes, it is a problem. I don't think it's as serious a problem for the banks as back in 2008 when it was the focus. That was the epicenter of the problem. But in this case, I think the real epicenter is in the real economy and its impact of this crisis on that and subsequently on the firms. And I'm not too sanguine the fact that too many zombies will be kept going, at least not in the United States.
Thank you, Ed. Let me turn to a host of questions that have come from probably 10 or 12 of the participants, and they all have to do with the Federal Reserve and the US Treasury support directly through the Treasury of the real economy and indirectly by the Federal Reserve through the bond markets. Now, historically, the Fed has limited itself to support to investment grade collateral. Even that, many would argue, is sort of a step further than what is typically done, which is to support either the treasuries or the sort of government-backed agency debt and agency mortgage-backed securities. What is your take on these support measures so far? Are you in favor of the recent facility, which is even planning to support directly the junk bond market? Are you concerned about the moral hazard there in the sense that the equity of these companies is not yet wiped out? Equity of many people who have invested in these firms has not been wiped out. So on the one hand, we started with an initial condition which was frothy. Risks were perhaps not fully priced in by investors, by rating agencies. And the way we are responding to the shock is to perhaps create a similar train again. What's your take on the support so far?
Yeah, well, first of all, the support, as most of us now, has been unprecedented, far more than what was done back in 2008. And that shows the seriousness of this crisis and the fact that it is not just a financial crisis, but it's a health and an economic crisis in general. And it's affecting so many individuals, not only the big banks and companies. And that's why, of course, the original movement of the Fed and certainly the Treasury and the government's stimuli was focusing a lot on, originally, on the small companies and the individuals. Subsequent, as you said, the Fed came through with what I was scratching my head, Viral, by the way, and I said, Jesus, they're supporting the investment grade companies. And by the way, I think they read the triple B phenomena issues very carefully, the Fed did, in coming up with that support. And they're also, in this case, and I was scratching my head, I said, what about the companies that are more likely to fail, the junk bond companies and the fallen angels that were being downgraded or would be downgraded? I said, well, they're not going to be covered because they were triple Bs, and now they're junk and they were triple Bs before. But it turns out, you're right, they are being covered too as well. So first of all, very important what the government is doing. I think they, I'm not saying I and certainly my colleagues agree with everything they're doing, but the fact that they're pumping what's expected to be up to around $4 trillion into the economy, and now this new stimuli even more, that's 20% of GDP, that's incredible as a stimulus. And yet, most people think it's not enough. And so that's why we're looking for more. And part of the reason is that the financial markets react very positively to that, but it's very short term. And then when another piece of information comes out, it's almost like we forgot about the stimuli, and then they need new stimuli. So I'm kind of skeptical that it will be enough, but it is very important to show that the government is very much in back of this. I'm very concerned with the amount of debt that will be increased in the economy, and particularly at the Federal Reserve own balance sheet, and also the U.S. Treasury. And we're already at huge debt levels and deficits. With this, we're trying to save what's going on in the short run with the cost of the long run. Personally, I think without these stimuli, it would have been incredibly terrible. And so whatever was done was helpful. I'm worried a little bit about the fact that companies won't want support by more loans to put on their balance sheet. They do like the fact, and you pointed out the moral hazard, they do like the fact that their bonds and loans and by derivation, their equities are now being supported by the U.S. government in an unprecedented way. And so that's why the spreads have come down by 200 basis points, and the stock market made a pretty good rebound in the first 2 weeks of April. I think it's going to be short-lived, to be honest with you, and that's being shown by the fact that we're getting more stimuli. If it was, people thought it was going to be long-lasting, we wouldn't have needed it. And so I'm worried about that. I like the payroll stuff, although there's a lot of companies saying it's too complicated. They're worried about doing it. I personally I'm involved with a small company that is going to has applied for the loans through the Fed's activities, but it's just a Band-Aid, they feel, in the short run.
We've unfortunately run out of time, Ed. I'm going to use one of the last questions as a way to conclude the session. It's about what might be a circuit breaker in the downward going spiral between the financial system, banks, and the real economy. I'm going to hand it over to you to have the last word, but my conjecture, it might be the flattening of the virus curve, I think, the infection curve. Yeah. I don't know if there's any other real circuit breaker that's out there. But over to you, Ed, for your last word, and then we'll wrap up the session.
Thank you, Viral. Thank you, everyone, for hanging in there. Yeah, I think you're absolutely right in implying that, and that is, if a cure, which is likely to come before any vaccine, is widely accepted and not only tested well, but also produced in sufficient quantities that people feel comfortable with going out again. Businesses start hiring people back to work in a normal way. That will be certainly a huge benefit. I still think the economy will still be in a recession for a lot longer than the short run of a few quarters, because it takes time, those factors to really percolate down. I'm worried about the supply chain, but clearly that is, I don't see anything economically to move us back on track until we get that under control. And I wish so mightily, even though, as you know, I love bankruptcies for an academic interest, but I'm afraid we're going to have large numbers of bankruptcies, at least in the next 12 to 24 months.
That's great. Thank you once again, Ed. Thank you to all the participants. Just for your information, Ed, this has probably been the record attendance, at least in the Faculty Insight series that I have moderated. So it shows how important your insights are, how important the issues of credit market stress are at present. And we all hope, as we conclude, that we do get the circuit breaker in the form of a better handle on the spread of the virus. So with that, let me conclude the session. I hope you and your loved ones are all safe and continue to do well in these difficult times. Thank you.
Thank you, Viral.